Welcome to BetterBooks with Kathy Houston. In this part of the training, we're going to dive deeper into the balance sheet and discuss the three sections that make up the balance sheet: assets, liabilities, and equity sections. If you haven't already done so, go into your software and print a copy of your balance sheet so that you can follow along as we discuss each section. To reiterate what we discussed previously, your financials consist of a balance sheet and an income statement, or what's commonly known as the profit and loss statement. For simplification purposes, I want you to think of these statements as this. The income statement shows your income and expenses for a given period. The balance sheet holds ongoing balances such as bank balances, money that's owed to you, loan balances, and money that you owe. So let's get started by discussing the assets. Assets are our bank accounts, any money that is owed to us, and fixed assets such as equipment, buildings, and vehicles. What is a liability? Liabilities are debts that the business owes. The two most common types of liabilities are current and long-term liabilities. Current liabilities are debts that are paid within 1 year. Long-term liabilities are debts that are paid over a period of more than 1 year. Examples of current liabilities are accounts payable, credit cards, short-term loans, and payroll liabilities. Some examples of long-term liabilities are auto loans, or any business loans that are payable over more than 1 year. What is equity? Equity can mean different things for different types of entities, but for this example, we're going to use an LLC or an S Corp as the entity for the description for equity. Under equity, you would have shareholder contributions, which is any money or property that the shareholder has contributed to the business. You will have shareholder distributions. This is any money that has been returned to the shareholder or that the shareholder has taken out. Retained earnings is any money that has been earned in prior years that was not taken out by a shareholder. And then net income is the income that we're showing for the current year. Cash versus accrual. What does it all mean? Cash basis accounting and accrual based accounting is only a sales and expense timing difference. Cash basis accounting records sales and expenses when money is received or paid. Accrual based accounting records sales when they are invoiced, not paid, which is known as accounts receivable. And it records bills when they are received, not paid, such as accounts payable. What is the book versus tax? Well, it's very common to have your books as accrual basis and your tax as cash basis, meaning that you could use your accounting software to issue invoices, which is accounts receivable, and or enter bills to be paid at a later date, which is accounts payable. But when you complete your tax return, you only report income that was deposited into your bank and expenses that were paid out of your bank. This way, you're not paying tax on income that you have invoiced but not received. This is completely acceptable and very common. Most software allows you to pull reports that can be viewed in cash or accrual basis. So if your books are on accrual basis, when you get ready to do your tax return, you'll pull that same information, your profit and loss, on a cash basis, and then that will show you the amount of money that was deposited into your bank and any expenses that were paid out of your bank during that period. That was a more in-depth overview of the balance sheet, discussing the assets, liabilities, and the equity accounts. And now it's time to start the cleanup of your books. And I'm really excited to take you through each account and help you to understand each account and how they affect your books, and also to clean up any discrepancies that you might have.